real estate median home prices have increased at 8.5% year over year. Guys, real estate on average goes up 3 to 5% year over year. Now, despite seeing real estate prices almost triple this year, we just had a record high of existing home sales. Home sales went up 24.7% month over month. Now, I'm a real estate agent and I'm a real estate investor here in Orlando, Florida, and I always look to find out when is the best time to invest my money. And that's exactly what we're going to do today. We're going to look at what economists are saying about the housing market and the future of the housing market so we can understand when is this market going to crash, if it ever is. So the first question that we're going to look into is what kind of recovery can we expect to see? The first economist that we're going to look at is Mark Fleming. He says, "It seems hard to deny that when one looks at many of the housing market statistics, a V-shape is quite apparent. The main reason for the strong rebound is that factors existing before the coronavirus hit, which include a lack of supply, low mortgage rates, and a millennial demand for home ownership, have continued or even gained strength. Mortgage rates are even lower, supply is even tighter, and millennials are still house hunting." So what Mark is saying is that a lot of these things that were driving up demand in the real estate market before the crash were sort of pent up during the initial impact of the coronavirus, right? February, March, and April. And now they haven't gone anywhere and they're back and even stronger during June, July, and August. And I agree with that. However, I believe that there is going to be sort of a tapering off because there was such a pent-up demand during those months and that we're now seeing that pent-up demand being released here during the summer months. I think that pent-up demand is going to sort of decrease here coming after the summer months. I don't think prices will decrease. What I'm saying is that I think the rate at which we're increasing will decrease. Now let's look at what the second economist, Ralph McLaughlin, says, who is the chief economist and senior vice president of analytics at Haas. He says, "It's going to be a W-shaped housing market recovery for 3 reasons. First, we think that there will be an initial rebound simply due to pent-up demand for home buying that would have otherwise occurred in March, April, and May, but simply would be pushed to June, July, and August." That's the same thing that Mark said and the same thing that I said here as well. "But after that, we're not expecting new demand to replace it at comparable levels, which will lead to another drop in activity." Okay, so I agree with this, but I want to clarify. Ralph doesn't clarify exactly what he means here, but I'm going to clarify what I mean and what I think he means. He's saying that, right, we had that pent-up demand in the early months. Now we're seeing it being released here in the summer. And after this, we're not going to see that pent-up demand replaced. I agree. I don't think Ralph is saying that we're going to see prices go downhill after summer. I think he's seeing that we're not going to see this heat, as much demand as we're seeing right now. Now, the reason why I'm saying I don't think we're going to see prices decrease is because a lot of these new home buyers, a lot of the home buyers right now, 34% of them are millennials. They're first-time home buyers. First-time home buyers are typically between the age of 30 and 35, and that's the age group millennials are entering into right now. So as millennials enter into this age, it's not just a 3-month thing where they turn 30 to 35 and then it's over. Right, it lasts a couple years. So that's why I believe demand is going to continue to be strong. That's why demand was strong before the coronavirus, and that's why it's still strong right now. But the reason why we're seeing it 24.7% of home sales go up month over month is because we had almost no home sales during the pandemic, and all that pent-up demand is being released now. Now let's look at his second reasoning. Second, I think we're seeing this already, is that the virus will make a comeback, which will lead to less demand for home buying in the fall. And third, there's a possibility that we'll see a broader impact on housing demand if the federal unemployment insurance bonus runs out at the end of the month. I agree, except I think, if the coronavirus comes back, not only will we see a decrease in demand, I think we'll again see more of a decrease in sellers who want to put their homes on the market and who don't want to have people walking through their homes. And I think that will balance out the demand and supply like it did in the original early stages of the pandemic. And his third reasoning, the unemployment insurance running out, I agree. I think that will have a longer run impact though. I think that his W should kind of look more like a really deep, long sloping parallel line, because Unemployment insurance really affects the lower income workers. It affects more of the renters. And renters aren't going to directly impact the home buying market, but they will have an impact down the road, right? Without renters getting unemployment insurance, GDP will slow because they're the ones who have been propping up GDP right now. And as GDP slows, businesses will have less money. Then we'll see more layoffs. As we see more layoffs, then in turn, eventually down the road, real estate prices will go down because then you'll have less demand, less people who have jobs who can buy houses. But as you see, that's kind of like a slow, long trickle-down effect. It's like throwing a rock at a water and it skips and hits this one and this one and this one and this one. And by the time it gets all the way down to the end, now we're seeing the impact. Now let's look at what Taylor Marr has to say, lead economist at real estate brokerage Redfin. He says, most certainly a W. So now we got two economists saying a W, one saying a V. Though the second dip is likely to be way more muted than the first. I agree. And in the first dip, we didn't see much. We saw a huge decrease in the amount of homes available, but we only saw home prices go down about 5%. So Taylor's saying that he thinks it's going to be way more muted. So prices, might go down a little bit. Small correction. That's what a correction is. A correction is a less than 10% drop. A crash is more than 10%. I think a lot of people get that confused. I think a lot of people think a crash happens way more often than it really does. Crashes are really rare, and we need to understand what causes a crash, right? In 2008, what caused the crash is that we had so many homes come up for sale at once, and demand stayed the same. That's what caused the crash. So we have to kind of look here and see what would probably cause, a crash in this situation. Well, the same thing. Right? If we look at what happened in 2008, what caused all those houses to go up for sale at the same time was due to bad loans, right? People not being able to make their payments due to crappy loans. Well, the same cause might not apply here, but the same factor still does apply, right? In order for there to be a crash, there still has to be a huge amount of supply all at once without demand picking up. Now, what causes that? It can be different. I think what could cause it, well, I'll save that for the end of the video. Let's keep going on through the rest of the comments here. Is the home buying demand we are seeing today sustainable for the rest of the year? Fleming says, no, it will tail off a little. When the virus hit and we all had to stay at home, the haircuts and restaurant meals missed were consumption never to return. But home buying can be deferred. Part of the big surge in demand as staying at home orders have been lifted was a pent up at home spring demand, which deferred until the early summer, which is what we said basically to the previous question and what we've been saying all along in this video. So I expect that as deferred demand works its way through, demand will cool down, but I still expect it to remain strong by historic standards. Our research shows that millennial demand for home ownership continues to gain strength and is a strong demographic demand tailwind for the housing market. So again, this reiterates exactly what I was saying before, is that yes, we had pent up demand. So this demand that we're seeing here in the summer, it is going to cool off. We are going to see, just like how after the summer's over, it gets cooler outside. We're also going to see the housing market get cooler. But the millennial demand and low interest rates are allowing the millennials to buy homes. That's not going anywhere. So we're still going to see a strong housing market even after this buying surge. For those of us thinking real estate prices are going to crash in 6 months, the economists aren't seeing it. I'm not seeing it. But let's keep looking on. In fact, the next question is exactly that. Where are home prices going? Fleming says, our research has found that in past recessions, house prices show their downside stickiness, meaning they remained flat or their growth slows during economic downturns, but often do not decline much with one exception, the Great Recession, which is 2008. Because of the downside stickiness of home prices and the supply and demand imbalance that exists in today's market, we anticipate nominal house price appreciation to actually accelerate this summer. House prices are going up. Yes, we see that's already happening. Marr says, as mortgage rates decline, prices rise. Well, we saw that happen as well. Demand fell, but so did supply. He's just stating facts here, which muted any impact to home prices. Right now, they're continuing to grow at the same pace as before the pandemic, yes. Growth may slow as the economic impacts grow, but the consensus is that home prices will continue to rise over the year. Okay, so we have one economist saying that for the next year, we're going to continue to see home prices rise. Tucker says, overall, Zillow is forecasting a slight decline in home prices through October, followed by a slow recovery through 2021. Now, interesting, Tucker an economist at Zillow, is saying something different. Tucker is saying that he's expecting a slight decline in home prices from October, right, through kind of the rest of 2020, and then we're expecting to see a slight recovery through 2021. If he's talking about, he's thinking that real estate prices are going to go down through the rest of 2020, I disagree. If he's saying that we're going to see prices increase at a decreasing rate through the rest of 2020, and then we're going to see that rate pick back up throughout 2021, okay, I think that makes more sense. Because again, we're looking at the statistics. There's no reason to believe that real estate prices are going to correct or crash in 2020. Interest rates aren't going anywhere. Consumer confidence is still high. Millennial demand is still out there. What we're really kind of more worried about is a foreclosure crisis. And and I'm going to get into that, like I said at the end of the video, what I believe could actually cause a crash and when that time frame could be. But let's move on to the next economist. McLaughlin says, we think price growth is going to slow and even possibly turn negative by the beginning of next year, 2021, as lower aggregate demand emerges and legislation that protects homeowners from foreclosures expire. However, we do expect price grow quite strongly by the end of next year, growing between 4 to 6% on a year-over-year basis. Okay, so I'm just going to share here my input on when I think prices will go down, because it's exactly what McLaughlin just said. Basically, what I think is saving the real estate market right now from a crash, right? Because we understand for a crash to happen, there has to be a sudden increase in supply without an increased demand, and really foreclosures are what are standing in the way. But what's preventing foreclosures? Why can't that happen right now? Because of mortgage forbearance. Now, mortgage forbearance will go away, right? Some people can get mortgage forbearance for up to 12 months. That's why, that coupled with the Fed basically promising not to raise interest rates for like 2 years, coupled with millennial buyer demand, consumer confidence, and the mortgage forbearance for 12 months, that's why I don't think real estate prices are going to crash in 12 months. Now, after the mortgage forbearance is over, if the economy has not recovered, like big time, like we're not back to normal, unemployment rate's not back down, and there is no more mortgage forbearance put back into place, be very careful. I could definitely see a lot of people starting to miss out on their payments and a lot of foreclosures starting to happen. But again, foreclosures are a long process. And especially if they all happen at once, it's going to take a while to get them on there. It could take even a year. So we're looking at a year until that mortgage protection expires. And we're looking at another year to kind of get all these foreclosures on the market. So it's kind of a lot further out there than what people are really expecting. And that's what McLaughlin is saying here as well, where he says, and legislation that protects homeowners from foreclosure expire. But then he's saying after all that's over, then he's expecting prices to grow again at 4 to 6% on a year-over-year basis. The longer this coronavirus, this pandemic lingers around, the longer it's going to take for the economy to recover. The longer it takes for the economy to recover, the more at risk we are of having people out in the market without an eviction ban, without a foreclosure ban. The more risk we have to seeing a market crash. So again, I think the market crash is a little bit further out there than what people are expecting or even kind of hoping for, or I guess your investors are hoping for. But stay tuned. We're going to continue to track the market. We're going to continue to see the economic updates so that we know and we get a better idea of when is the right time to buy, because outside of a year, it's really hard to figure out what's going to happen. All we can really look at is within a year's time. And within a year's time, guys, I'm not seeing a crash, and neither are these economists. If you liked the video, if you learned anything new, like, comment, share, subscribe, and I'll keep you guys updated from here on out. Thank you.